Happy New Year, everyone. Welcome to our quarterly webinar. Uh, we're going to cover a lot of the normal information this go around, but I think there's going to be some interesting twists to this one that both Adam and Andy will share. But I'll start by just you know, addressing the fact that we're going to have a change in the White House. President Trump has set expectations for a lot of actions, day one action. The area that I think is going to be of most interest for investors is what he does with his tariffs. He's got a lot of unilateral control over what he does there, and he's going to want to make a big splash with what he does. Initially, and part of that's going to be maybe real, and part of that's going to be posturing. It's part of the way that he operates. Is there's always going to be uncertainty in terms of what's really his goal at the end. But don't be surprised if there's some market volatility that is associated with this. The one thing the market doesn't like, as we all know, is uncertainty. So in the beginning, when it's not clear, maybe we could have some disruption. I think once it becomes clear, it'll get quickly priced into stocks, and we've already seen that to some extent. Just with sort of since the election, how asset prices have adjusted in anticipation of President Trump taking office. So Adam, in his slides, he kind of goes over the same material, short-term and longer-term performance. There were some real surprising returns that I saw on the quarterly slides. And then there was another really very surprising one to me on the longer-term slides. There's been one best place to be, and from a general asset allocation standpoint, and fortunately for us, that's where we're mostly concentrated. And then on top of the, kind of the base returns, we've had a really good run in terms of, boosting those with our stock selection and portfolio construction. And I think Andy might cover that in a little more detail. We've had a market that's been led by the big growth companies, the Mag 7 and whatnot. There's an expectation, Goldman, we mentioned this previously, Goldman put out an analysis where their expectation for those stocks for the next decade are actually not very positive. As you all know, we have sort of a tactical approach with in terms of how we position with respect to size and style. Kind of the process is all about respecting the power of momentum in the short run, but then also the inevitability of mean reversion in the end. And so there's likely going to be leadership change in the market, and you're going to see adjustments in our portfolios in response to that. So Adam, you're up.
Great, thank you, Lowell. And real quick, everyone, before we dive in here on the housekeeping front, you have two options when it comes to pushing through a question. There's the chat function and the Q&A down at the bottom, so feel free to use either of those to submit a question, and we'll most likely circle back to those at the end. But just looking at the last quarter of the year specifically, very different picture than what we did when we reviewed Q3 just a couple months ago. In many ways, Santa Claus stayed at the North Pole for the last few weeks of the year. In the last quarter of the year, we were really, market-wide hopeful for a strong close to 2024. All the momentum was in our favor. If you look at what was happening in terms of interest rate cuts, the economy still looking relatively strong. But in many ways, globally, things, kind of fizzled out the last part of the year. U.S. equities were still able to eke out pretty average positive gains. But outside of that, you saw a pretty meaningful sell-off in both global equities and domestic fixed income. A lot of this has to do with the fact that in spite of the fact that we had a really nice rate cut in September of 50 basis points, you actually saw yields go up pretty much across the board. So a really good example of expectation versus reality, really driven by a number of reasons, but whether it's politically driven or concerns about inflation being stickier than maybe we would have thought. The year end kind of took a little bit of a breather at the end, and that's okay. I'm going to we're going to zoom out, but we're also going to address some of the key questions that we've been getting leading into the end of the year from clients about how much longer can this really run. So Andy, if we slide forward here, just on the longer term trends, as Lowell alluded to, specifically since really the big COVID sell-off, it's been a tale of really really two different stories here in terms of equity returns and performance. Our stock market has had no problem finding their footing and recovering, mostly because we're still home to some of the biggest and best companies in the world, the most innovative, the most profitable, and that just continues to be the case. We see Europe and other emerging markets kind of waiting to pick up some momentum. And then the interest rate sensitive asset classes like real estate and fixed income, have been trying to navigate this interest rate environment. This, kind of two different stories playing out in any given moment around, are rates going to go down? Are they going to go up? And how's that going to, marry itself with the inflation narrative? But certainly something we're watching. And I would say the biggest questions we're getting right now, there's two of them, specifically as it relates to domestic equities, is how much longer can this run? And what should our expectation be for 2025 since we've had such positive and high momentum performance. So if we slide through here, just a couple pieces before Andy looks under the hood at what's happening. One of the pieces of information we've been looking for is around, what happens when we have back-to-back 20+% gains in the stock market. There isn't, when we think about stock market history, we can go back, 100 plus years in a lot of cases and try and find trends or prior, pieces of history that might give us some sort of an idea of past market behavior. But in the case of back-to-back 20+% gain years, it's pretty limited. This has really only happened a handful of times. Um, and that's when you read the headlines and see, probably one of the main pieces of information thrown out there, hey, 2024 just, closed out our second 20+% gain. What does that mean for investors? But you see here, we're really kind of going from left to right. We've got the calendar year, the first year return for the market, the second year. So in both of these columns, you'll see 20+% gains. And then what happened in year three beyond that? And you'll notice a pretty good batting average in all, four cases. This has happened before. We eked out positive gains in that year number three with an average return and median return hovering right around 20%. So not as much, not as much high volume data that we'd like to see when coming to any sort of conclusive opinion or decision around what happens. But in the cases where this has happened before, momentum played in favor, and the market closed off in, in strong fashion. And if we kind of toggle through here, next, let's call it the next big question we've been fielding from clients is we heard a lot about all-time highs last year. I think it was, 55-ish all-time highs we notched in 2024, which was significant. Actually, going into Q4, we were on pace for an annual record in terms of all-time highs, but we didn't quite get there because of how things slowed down a little bit there at the end of the year. But we get a lot of questions that did last year around, hey, every time I open up, my phone or kind of take a pulse on the markets, I'm seeing something about an all-time high. Should I be nervous about that? And we brought this up a couple times at prior webinars in 2024. Is that, historically speaking, all-time highs is a bullish indicator, not a bearish indicator. And you'll notice here, going back to 1926, what have the forward-looking returns been on a 1, 3, and 5-year basis after the S&P 500 notched an all-time high? And you'll see numbers that look pretty encouraging and pretty strong. And that lends itself to just the typical narrative that market strength plays on strength, and all-time highs in many ways, even though there's this general feeling that because something's gone up or there's been strong positive momentum in the market's favor, that it must cool down or there must be sort of some reversion to the mean in the short term. That actually hasn't played itself out to the same degree as the continued strength has. So that's really interesting, something we've been sharing with clients. And the last piece here is just around, something we've also shared and looked at before around the history of prior bull markets. How long do these things normally last? So you see at the bottom, we're going all the way back, almost 100 years here. And quite simply, the blue tealish lines here represent bull markets, and the red little blips represent bear markets. And you can see their corresponding percentage gain or loss through each window, and also the length of time um, in terms of how long that they've lasted historically. So if you boil it down, bull markets in and of themselves, tend to last, anywhere on average from 5 to 7 years. So we're from a uh, from a number standpoint in historical context, still fairly early on paper in this bull market. And bear markets or 20+% sell-offs tend to happen, once every, 5-ish years within, just outside of that window. Certainly some are stronger than others. You notice, in the late 70s all the way through the 90s, we saw some significant market strength with only a very minor sell-off buried in there. And you notice other windows like, certainly back in the 30s, and even more recently, we've had a handful of bear markets in a short window of time that bucked the trend. So these come in all different shapes and sizes, but in general, on paper, with the strength of the market and just the general state of the economy, there's certainly still positive momentum in its favor. And we certainly coupled with this, Lowell alluded to the changing of the guard in the administration. We had a town hall last week where we spent some meaningful time talking about the economy in general. But if you boil it down, a lot of times we're searching for data or information that kind of might try and help us confirm a more bearish or negative outlook, but the reality is, and especially with this morning's relatively encouraging inflation reading, we've got 4% unemployment, roughly 3% economic growth, and a pretty strong profitability and earnings outlook for the S&P 500 and the rest of the market. So certainly, like anything, surprises and short-term volatility is always a possibility, but still a lot of really positive things to point to. And with that, one more thing before I pass it to Andy. And we were talking about this a little bit last week around, the best time to revisit the risk level of your portfolio and your comfort level with the amount of risk you're taking is from a position of strength when markets are doing well and it's relatively calm, and you feel like you're making a decision proactively, not reactively. So I say all this about our observations about the equity market, knowing that life changes, circumstances change. So this is a really good time kicking off the new year to talk with your advisor about the risk level of your portfolio. Does it still make sense based on life changes or other plan changes? Should we think about readjusting things if necessary? So Andy, I'll pass it over to you.
Yeah, that's a great point. I always like to say it's best to rebalance from a position of strength. So, if you are going to make any material changes to the risk level, markets near all-time highs is always a great time. And I appreciate that context, Adam. For the broad level stock market view, I always like to take, my section here and look a little bit under the hood. And I think that January is oftentimes a great time to look back at what worked in the prior year, as well as looking forward to what we expect to work in the new year. So certainly looking back at 2024, I'll lead off with the thing that worked best is growth. And you may or may not have actually received our billing letter yet. We just mailed them out this week. But when you read that letter, we'll mention that this may have felt a lot like deja vu in 2024 when comparing it back to 2023. If you look at the similarities, we saw the market cap weight S&P 500 up in the mid-20s. We saw the Dow, the equal weight version of the S&P 500, and the small cap Russell 2000 kind of down low in the mid to low teens in terms of performance. So back-to-back years, we got nearly identical returns. And the big driver for those returns really was large growth. Well, growth, and really I would say particularly that large growth section of growth. And for us, really this growth outperformance wasn't surprising. because this current pro-growth market phase that we find ourselves in really started at the beginning part of 2023. And when you look back historically at how long a growth phase typically lasts, it's somewhere in the ballpark of 18 to 30 months. So we're kind of right at that, average mark for how long a growth phase will last. So, for us, when it comes into, coming into 2024, based on history, we expected the growth to outperform, and it did. But I will point out that while growth had a good year, the momentum factor actually was even stronger than growth. And to me, momentum is a really, really interesting factor because it's not something that works all the time. There are times where you want to be leaning into the types of stocks that have been doing the best most recently. And there are times when anti-momentum really pays off. So if I look back at big bear markets, that's a time where maybe you want to be buying the worst performing stocks. But the way that we play momentum when it comes to our portfolio construction process is there's really two key momentum metrics that we look at. The first one, we kind of tongue-in-cheek call ISORs. This is a very simple measure of momentum. It's simply the bottom 5th percentile of stocks in our investable universe over the last 6 months. Those are the stocks you want to avoid. So if any of those types of stocks are in a portfolio, we'll be very aggressive about clearing them out in a bull market like we find ourselves in right now. And we have been. So if you look at the performance of those ISOR positions, so those very worst performing positions in 2024, they actually lost ground relative to the rest of the market, about a 14% differential between those worst performers and just the regular old stocks in the investable universe. So it definitely makes sense to cull the losers in a portfolio. But the other metric that I really like is kind of more of your standard moving average comparison to generate either a bullish or a bearish signal. So basically, stocks that have been outperforming short, mid, and long term, they tend to keep going up. Stocks that have been underperforming over a short, mid, and long-term interval tend to keep going down. This measure of momentum was even more effective, where the differential between the buys and the sells were nearing 27% in terms of performance. And so I really like this metric because it gives us both a bullish and a bearish signal that we can use in the portfolio construction process. So again, we've been very aggressive about clearing out the bearish moving average signal. And when it comes to timing stocks to go into portfolios, we've been showing preference to the stocks that have that bullish signal. So this was a really strong factor that worked in 2024. I think we've mentioned that a couple times on these webinars. And the other thing that worked really well, I think, is something that's a little surprising. I mentioned at the top here that we saw large growth again, just like 2023, outperform everything. And if I think back to 2023, this was a time where we really talked about the Magnificent Seven. That's really, I think, where that name really got branded, was in that year. And what happened in that year was there were times, especially mid-year, where the top 7 stocks, those Magnificent Seven stocks, made up the entirety of the S&P 500's performance. So I always like to differentiate between the market cap weight version of the S&P 500 and the equal weight version, because it's the exact same stocks in both index, just weighted differently. So the S&P 500 that you get quoted when you're watching CNBC or you go to Yahoo Finance, it's always the cap weighted index. So it's going to show preference to stocks like Nvidia and Apple and Microsoft. These stocks have a 7% plus weight. The top 10 stocks in the index are, over 35% of the index itself at this point in time. And so they really, however those stocks do, it tends to have disproportionate pull. But if we look at just the equal weight version of the S&P 500, it was up 13% last year. So certainly not bad, but not nearly as good as, what you would expect out of the S&P 500. And it's tempting to say that just like in 2023, the Magnificent Seven drove that performance in 2024, because the Magnificent Seven did perform quite well, especially a stock like Nvidia. That as a whole, that group of stocks was up 61%. Just doing a simple average last year. But I've got a question for people. You don't necessarily need to post it in the chat, though feel free if you want to. But how many of those Magnificent Seven stocks do you think were in the top 20 of all stocks in the S&P 500 last year? The answer may surprise you. It was just one. That stock was Nvidia. And the next Magnificent Seven stock was was Meta at number 25. And so when I look at the top 20 names, I see like energy stocks like Targa Resources. I see industrial stocks like Howmet Aerospace. And I even see tech names that you may or may not have heard of before. Broadcom is one of them. It just joined the $1 trillion market cap club. But, Arista Networks is another one that performed very well that may be a bit more of an unknown. So my point here really is that stock selection opportunity really did exist last year. It wasn't just those top names doing the best. The way that we look at our stock selection effectiveness is we look at the group of stocks that our model says is a buy, and we look at the group of stocks that our model says is a sell, and we compare the performance between those two groups. So through the end of 2024, that differential between the buys and the sells was 9.4%, which is, I think, the strongest that I've ever seen. I don't know, Lowell, you're on this call. You've been here longer than I have. Have you ever seen performance this strong in our stock selection model?
Only in a recovery year. There's a time where there's a normal time where there's that kind of scale of performance capture. But you don't see that in a classic middle of a bull market type year. That is the best that we've had in a normal market.
Yeah, and maybe a follow-up webinar will be some of the reasons for that, because there have been some iterations of our modeling process that we've implemented live. But all in all, a good year for stock selection. I did want to point out one factor that maybe didn't go quite as expected, and that is the performance of small and mid caps last year. So it's been a bit of an enigma, I think, when you look at small caps, because we've been expecting a small cap phase to materialize for a little while, and we've positioned portfolios to be prepared for it. But we keep getting these periodic, very strong pro small cap months. I'm thinking back of December of 2023, July of this year, November of this year, most recently. Usually what happens is we get good news on inflation, or we get expectations that the Fed's going to start cutting rates, and we see small and mid caps really rally strong. But then for whatever reason, that momentum fizzles, and we see months and months and months of pro large cap momentum retake the lead there. So I think these head fakes to inflation and the Fed interest rate expectations has been something that's been a bit troubling for us, I would say, this year, and it's going to be something that we're going to continue to watch very closely as we move forward into 2025. And so on that topic of looking at small and mid caps, it's, I think, a really interesting time for it, because if you look at valuations, this is part of the reason that we're leaning into small and mid caps right now. You look at the valuation of small caps relative to large cap stocks, they're just much cheaper than large cap stocks. Large cap stocks are nearing valuations in the 30s. The Magnificent Seven is even higher than that, and that's really driving much of the valuation gap there. But generally speaking, you want to buy low, sell high. So large caps are high, small caps are low. You want to lean into small caps. But some of this performance maybe is justified, because if you look at small cap companies, their profitability rates, while expectations were to improve, have actually declined over recent years. And so a big reason that small caps still, aren't achieving the types of gains that large caps are is because of this profitability concern. But when we look forward to 2025, there is the expectation in the market that we're going to see a breakout in terms of earnings per share. So I think this is partly because small caps are coming from a relatively, lower, earnings growth base, but the expectation is to see quite a big recovery in the earnings of this group. So I think the thing that the market is waiting for, it's waiting on confirmation that this is real. There were also expectations that small and mid caps would do better. Maybe the lower end of the S&P 500 would improve last year, and it just didn't quite come to fruition. Analysts kept revising down earnings expectations. So I think the market's really waiting to see if we're going to get this rebound in earnings per share. But if we do, we think that that's going to be a nice, strong catalyst in the small and mid cap group. So something to watch, something that we'll be watching intently. I think what's really going to matter here is inflation and Fed interest rate policy. The Fed gave what was called a hawkish rate cut in December, where they did cut rates, but setting expectations moving forward, there were expectations for maybe a slower pace of rate cuts moving forward. I think the Fed's really waiting on a new administration coming in, see what kind of impacts that has, if any, on inflation, and then act from there. So that delay, I think, is why we kind of got head faked in November for small caps. But as we get more certainty, as Lowell mentioned at the top, we believe there's a strong likelihood that we see small and mid caps break out. The other change that we're expecting is we are expecting value stocks to begin to do better. As I mentioned, we're kind of right at the midpoint for how long we can expect a growth phase to last. Just in November, we saw some growing value momentum. And so we came off our maximum growth bet that we had on at the time. So we've been leaning as far into growth as we can for over a year now. And that positioning has paid off. But we're seeing signs of life with a broadening out of the market. So hopefully that small and mid caps, but also that's going to apply to value companies as well. So we are expecting a value phase to materialize at some point in 2025. My expectation is that you can see more trading this year as the data comes in, where we start moving even further towards value. We're still pro growth in terms of our posture, but that could flip in 2025. And one final point here I want to make is some of you may have been seeing some relatively bearish forward-looking return expectations from some of the major asset managers like Goldman Sachs and Vanguard. I think those are the most bearish forward-looking S&P 500 forecasts that I've seen. Goldman made waves back in the fourth quarter when they predicted just 3% annualized returns for the S&P 500 over the next decade. When we look at Vanguard's expectations, it kind of tells a similar story. They both have lower expectations for US equities, sure, but really they have lower expectations for large caps and specifically large growth. So that segment that we saw earlier that did the best this year, I think partly because they've done the best this year and valuations have grown, expectations now that group might struggle moving forward. So I think some people have sent this to us asking concern like, hey, is equities the right spot? Are we going to have a lost decade like we had back in 2000? And, I think that it's certainly the case that there is record market concentration and valuations in some pockets of the stock market do look stretched. That being said, those stocks that look the most stretched valuation-wise are also the biggest, most profitable, fastest growing stocks that maybe we've ever seen. So some of that certainly is justified. But I do think that over the next 10-year time frame, it will pay off to go down market a little bit, whether that's the S&P 490, whether that's mid caps, whether that's small caps. I think there's going to be quite a bit of opportunity in that space to generate returns. And it could be the case that you need exposure to those areas of the market to get the type of equity returns that we're looking for historically. So that's actually what Vanguard's saying. If you look at the small cap, you look at value companies on their forecasts, those return expectations are higher than large cap equities. If you look at under the hood of the Goldman forecast, they're predicting, more normal returns for the S&P 490 versus the S&P top 10. All this is to say, I think it will eventually pay out to have broader exposure, both in the US and maybe if you're an asset allocation client to alternative investment classes as well as international stocks. So with that, we've come to the end of the webinar. I did not see any questions come in, so I think we're going to leave it there. We like to make this a nice tight 30 minutes. So we certainly appreciate all of the clients who've joined us today. We appreciate the work that we do together, and we look forward for a fruitful partnership in the new year. Thank you.